Capital gains are the profits earned from the sale of assets like stocks, real estate, or bonds. However, not all capital gains are treated equally under U.S. tax law. The IRS distinguishes between short-term and long-term capital gains, and this classification has a significant impact on how much tax you owe. The main difference depends on how long you held the asset before selling it, but other key factors, like tax rates, exemptions, and implications for financial planning, vary as well. Understanding the distinctions between short-term and long-term capital gains is essential for investors, business owners, and anyone managing a portfolio. Knowing when to sell, what tax rate applies, and how your filing status affects you can result in major tax savings. This video explores the top 10 differences to help you make more informed and strategic financial decisions. 1. Holding period. The most fundamental difference between short-term and long-term capital gains is the holding period. A short-term capital gain results from the sale of an asset held for 1 year or less, while a long-term capital gain comes from the sale of an asset held for more than 1 year. The exact holding period includes the day after you bought the asset and ends on the day you sell it. This distinction matters because it directly determines the applicable tax rate, which can vary significantly. Investors often strategically wait to cross the 1-year threshold to qualify for lower long-term rates, especially for large gains. 2. Tax rates. Short-term and long-term capital gains are taxed at different rates. Short-term capital gains are taxed as ordinary income, meaning they fall under your regular income tax bracket, which ranges from 10% to 37% in 2025. Long-term capital gains, on the other hand, are taxed at preferential rates, typically 0%, 15%, or 20%, depending on your taxable income and filing status. For example, a single filer with taxable income under $47,025 in 2025 pays 0% on long-term gains, while someone in the top income bracket pays 20%. This major tax rate difference makes long-term investing more attractive from a tax efficiency perspective. 3. Impact on net investment income tax, NIIT. The net investment income tax, NIIT, applies an additional 3.8% surtax on certain investment income, including capital gains, if your modified adjusted gross income, MAGI, exceeds $200,000 for single filers, or $250,000 for married couples filing jointly. This surtax applies to both short-term and long-term capital gains, but its impact is more noticeable on long-term gains, which are otherwise taxed at lower rates. For example, a wealthy investor in the 20% long-term capital gains bracket might effectively pay 23.8% after the surtax. Although NIIT doesn't differentiate by holding period, it's often a bigger concern for long-term investors due to the larger gains from long-held assets. 4. Offsetting with capital losses. Both short-term and long-term capital gains can be offset by capital losses, but the IRS applies specific ordering rules. If you have both types of gains and losses, short-term losses must first be used to offset short-term gains, and long-term losses must first offset long-term gains. If your losses exceed gains, you can offset up to $3,000, $1,500 if married filing separately, of your remaining net loss against ordinary income annually. Any remaining losses carry forward to future years. This structure means your ability to reduce high-taxed short-term gains with losses can significantly impact your tax bill. 5. Implications for retirement accounts. In tax-advantaged retirement accounts like 401ks, IRAs, and Roth IRAs, capital gains don't matter, whether short or long-term, because all investment activity within the account is tax-deferred or tax-free. However, when assets are sold in a taxable brokerage account, the holding period becomes crucial. Gains realized within a tax-sheltered retirement account aren't taxed annually, but distributions from traditional retirement accounts are taxed as ordinary income, not as capital gains. This means short-term versus long-term gains are only a factor outside of retirement accounts, reinforcing the value of long-term strategies in taxable investments. 6. Influence on investment strategies. The difference in taxation influences how investors construct and manage their portfolios. Long-term investors are incentivized to hold onto assets for over a year to benefit from lower tax rates, which may encourage a buy-and-hold strategy. On the other hand, frequent traders or short-term speculators often rack up short-term gains taxed at higher rates. This means even if a trade is profitable, the tax bite can make it less rewarding. Tax-conscious investors typically avoid unnecessary short-term trading to minimize high tax liabilities, especially in non-retirement accounts. In short, taxation influences not just what people invest in, but how long they hold it. 7. Effect of filing status. Your filing status directly impacts how much tax you pay on long-term capital gains. For instance, in 2025, single filers with income up to $47,025 pay 0% on long-term gains, while married couples filing jointly can earn up to $94,050 and still pay 0%. Short-term gains, however, are taxed according to the same income brackets as your wages or other income, regardless of filing status. While filing status still affects your overall tax bill, it plays a more direct role in determining long-term capital gains rates, making tax planning around family income and filing strategies more important for long-term investors. 8. State tax treatment. At the federal level, short and long-term capital gains have distinct tax treatments, but at the state level, the rules vary widely. Some states, like California, tax all capital gains as ordinary income, regardless of holding period. Others, like New Hampshire, tax only interest and dividend income, and states like Florida and Texas have no state income tax at all. Most states do not provide a preferential rate for long-term gains, which means your state tax liability may not be reduced by holding assets longer. This makes federal tax planning more critical and may influence decisions based on where you reside or plan to retire. 9. Reporting on tax returns. Short-term and long-term gains are reported separately on IRS Form 8949 and summarized on Schedule D of your tax return. Short-term gains are listed in Part 1, while long-term gains go in Part 2. This separation is important because it helps the IRS apply the correct tax rate. Also, if you receive a Form 1099-B from your brokerage, it will usually specify whether the transaction is short or long-term. Accurate reporting helps avoid audits and ensures you're not overpaying in taxes. Properly tracking your holding periods and basis in each asset is crucial for accurate filings. 10. Timing opportunities. The decision to sell an asset now or later can have a huge impact on taxes. Timing the sale of an investment to qualify for long-term capital gains rates can result in significant savings. For instance, waiting one extra day after the one-year holding mark could drop your tax rate from 37% to 15% or even 0%, depending on your income. This makes tax planning not just a yearly activity, but something that should be integrated into your investment decision-making process. Timing also includes end-of-year strategies, like tax loss harvesting or delaying sales into a new calendar year to manage your income level and bracket. Understanding the key differences between short-term and long-term capital gains is crucial for minimizing your tax liability and maximizing your investment returns. From holding periods and tax rates to strategic planning and reporting, the IRS treats these two types of gains very differently. Investors who plan their asset sales with these distinctions in mind can often save thousands of dollars in taxes. Whether you're managing a portfolio of stocks, considering selling real estate, or weighing the benefits of buy and hold investing, knowledge of capital gains taxation empowers better decisions. As with all tax strategies, working with a qualified tax advisor ensures you comply with the law while optimizing your outcomes. The more informed you are, the more you can keep of what you earn.